In this video, I'm going to talk about a better idea than the portable mortgage that I talked about last week. So I'm going to share some of my ideas about how existing homeowners and first-time homebuyers could actually get the help they need to buy a house. If you watched my previous video, I went into detail about what the portable mortgage would look like under the proposal that the Trump administration has floated. And I heard a lot of you say, this will never work, this doesn't fix the actual problem. And I've come up with some ideas that I think will actually address those problems. So just a quick recap in case you didn't hear about the portable mortgage. The portable mortgage is an idea that allows you as a buyer to take your existing mortgage to a new home and just transfer that mortgage over. And as I detailed in the video, it's not as simple as it sounds. There's a lot of drawbacks with how mortgages are structured in America that would make it pretty difficult. Additionally, that does not help first-time homebuyers either. A first-time homebuyer, they don't have a mortgage to transfer over to a new property. So that would actually create more competition and potentially increase prices for first-time home buyers, which pretty much has the opposite effect of what we're trying to go for with mortgage reform. So let's start off with this. The real problem with the housing market today in terms of supply being limited is the rate lock-in effect. This simply means homeowners that purchased or refinanced their homes in 2020 or 2021 when interest rates were 2, 3, 4%, they don't want to sell those homes because they'll lose that interest rate. And with interest rates being somewhere around 6% right now, that could be a huge increase in monthly payment to get the same or smaller house. So millions of those homeowners are not willing to leave their home just because of that interest rate. There are many people that would sell their home if it wasn't for that. There are people that want to upsize, there are people that want to downsize, and there are people that want to relocate, but they can't because they can't afford the new mortgage under the current rates. And that's why ideas like the portable mortgage keep showing up. The idea sounds simple, but mortgages are not just an interest rate. They are risk contracts. They are priced on the home, the location, the collateral, and also the borrower's credit and history. It would simply make no sense for a bank to just take the same exact credit profile and transfer it onto another house, potentially in a completely different location. That's completely different risk. But what if we're simply thinking about it the wrong way? This is where some of my ideas come into play. But what if the fix isn't actually moving the mortgage itself? What if the solution is simply changing the way mortgages are underwritten? See, we could take these programs, especially government-backed programs like FHA loans, and make it so lenders must match or come close to the existing interest rate you have on your loan. So let's take an example. Let's say in 2020, you have a mortgage that has a 3% interest rate. And now in 2026, you want to sell that home and buy a new house, but you don't want a 6% interest rate. I think what would make a lot more sense is simply making it so you sell that house, you pay off that mortgage, and you apply for a new mortgage. You don't just transfer that same mortgage to the new house. But when you apply for that new mortgage, all that happens is the lender must come close to what your 3% interest rate was. So here are some examples. Let's say your credit profile and all of your other circumstances are pretty much exactly the same as they were in 2020 when you qualified for the previous mortgage. I think lenders should have to match that interest rate at that time. Now, let's say you have better credit. Maybe we just make it so the lender has to give you a slightly lower rate, maybe a 0.25% lower than you had before. And then on the flip side, if your financial profile is worse today, higher debt, lower income, weaker credit, the bank can raise the rate, but only up to a capped amount, say like 0.5%. And if your profile is better, higher income, stronger credit, lower risk, you earn a slightly lower rate. Risk still gets priced. Banks still protect themselves. The only thing removed is the idea that moving should reset your life back to zero. Now, this is why this idea would work better than a portable mortgage. Banks are still re-underwriting, collateral still matters, and risk still gets repriced. You're not pretending rates don't exist. You're just saying moving shouldn't come with a permanent financial penalty. And that, I think, is a huge difference in the way of thinking about this. Now, here's the part that most housing fixes actually ignore, because the previous idea, That only helps existing homeowners. But first-time homebuyers don't have an old mortgage to anchor to. So if you stop here, you risk making things worse for first-time buyers. And that's why you need a parallel track. First-time buyers don't lose because rates are high. They lose because they're forced to compete against people who have already won. People that already own homes. They're competing with cash buyers, equity buyers, and investors. So the fix isn't helping them bid higher, it's changing who they're bidding against. Certain homes, like starter homes, entry-level price bands, should be offered first to first-time buyers. Let's say they get a 30 or 60-day advantage. No investors, no second home buyers, no equity rollovers. That alone changes outcomes dramatically without price controls. And for financing, you apply the same anchored logic, just anchored to income, not history. Instead of market rates doing all the damage, rates are capped relative to local median income. Not a giveaway, not free money. Just a limit on how much income alone can be punished. This keeps risk pricing intact, without turning housing into an auction that you can't win. Homeowners get mobility without punishment. First-time buyers get access without unfair competition, and the market starts moving again. Not through a crash, not through massive subsidies, but by removing the friction we accidentally built into the system. Now, these ideas don't come without their downsides. So let's be honest about what those are. Banks would definitely fight against this idea. Margins would get compressed, and politics would get messy around this. This would also be very slow, very boring, and hard to get the headlines to cover exactly what we're trying to do, which is exactly why I think this could work. Real housing fixes aren't flashy. They're boring, targeted, and friction focused. They don't promise miracles. They just stop punishing normal behavior. See, the housing market isn't broken, the movement is. If you fix the rules that punish moving for homeowners and for first-time buyers, housing starts to work again. The question isn't whether people want to move, it's why we made it so expensive when they do. So let me know down below, do you think these ideas could work, or are they even crazier than the proposed ideas?